Hello and welcome to the latest Insider interview. Our guest today is Mark Slater, manager of the Slater Growth Fund. Mark, thank you very much for coming in.
Great pleasure.
We last had you in for an Insider interview about 2 years ago. Back then performance was going very well, but since about November 2021, performance has dropped off. Why is that?
Performance in mid and small cap UK has been incredibly weak in that period. The weakest I've ever seen it actually, relative to other things in the UK and outside the UK. So I think the change in the interest rate environment was the trigger. I'm surprised because clearly it wouldn't have surprised me at all if these companies which you see in the States on 50 or 100 times revenue, which don't make any money and won't make money for years, the idea that those would be destroyed price-wise wouldn't be surprising. So I'm hugely surprised by the extent of the derating in the UK, in the area we operate. Again, I think it's partly fashion, it's partly outflows, it's obviously the interest rate environment has created alternatives, so people can then, gilts are suddenly very popular. That's clearly a short-term thing, but they're popular for now. Annuities suddenly are interesting. So there's suddenly competition for money. The US has been on a tear, that people always chase performance, so that will have attracted money. And then, of course, you get into this vicious circle where if money comes out, prices go down, people have to sell, prices go down further. So I think that really explains it. There is fear of recession in most markets that has been affecting some of the forecasts, and it's been affecting some companies. But what's surprising to me is even those companies which haven't put a foot wrong, which are very unlikely to be affected by recession, they're treated pretty well the same as the others, that might be affected. So it's pretty indiscriminate. It's a very aggressive derating, more so than I think I've ever seen.
And can you give some examples of companies that from a share price perspective haven't performed well, but from a business operation perspective are doing great?
Companies like Serco, which is one of our biggest holdings, it hasn't been terrible, the price action, but it just doesn't really move. And that business is so much better than it was a few years ago. That's on a 10% free cash flow yield. So it's throwing off cash. They're retiring 6% of their equity per annum. They're cancelling it. It's trading on a PE rating of about 10 or 11. It's growing at a much faster rate than that. That's a company that is very unlikely to be affected by economic factors. It's got a very, very long-term order book. It's a very predictable business. But there are lots of examples. It's almost, it's hard for me to think of there are so many, it's quite difficult to actually think of a really good example in a way. It's almost a sort of paradox of choice. There's lots and lots of companies in that category. I mentioned franchise brands. Their shares are half what they were 2 years ago. They've done nothing wrong. They always beat forecasts. They do all of those things. Loungers similarly. But there's such a long list.
And it's not a case that these shares were expensive before rates began to rise.
In some cases they would have been. In some cases they would have been, but in many cases they were not. And these are not companies that were on crazy multiples of earnings. They were on normal kind of multiples of earnings. But they've been beaten up very aggressively.
And during these difficult periods, what do you do as a fund manager? What actions have you taken?
I think the most important thing is a sort of philosophical one, which is to remind yourself that things get better, because they do. And it's very powerful actually, because in the same way when markets were flying, people weren't really interested in risk and they assumed that good times would roll forever. But when things are more difficult, people assume that bad times will roll forever, and that's not true. So I think the most important thing is when prices are low, you've got to be on the front foot and you've got to be looking to buy. That's the most important thing. That's kind of it. Yes, you have to, in a difficult environment, you've got to stress test your belief in what you own. There is more jeopardy. We're in a complex world where demand has been slowing in some pockets. So it's tough out there, but I think one has to be on the front foot.
So lots of opportunities out there then.
Yeah.
What have you been buying? What are you excited about?
We've added to a lot of existing positions, and in a fast market, this has been a pretty fast market, our policy is normally initially to focus on existing holdings. We did a very similar thing in 2008. It was very difficult to forecast. There was lots of noise. So we focused on the companies we knew best. We've done the same in the last 2 years. So we've added materially to quite a large number of holdings in the fund, about 20. We're also beginning now to look to branch out and add new positions. The two instances of that recently have been franchise brands, which is a leading franchise business. It's first-class management. Is a magnificent business, very good growth, low multiple, ticks every box for us. And another is a company that is now called Team Internet, used to be called CentralNic until quite recently. Again, they've never put a foot wrong. They're trading on 7 times after-tax earnings now, huge free cash flow yield, and growing very, very nicely. So those are 2 relatively recent additions, and I would expect there to be a good pipeline of additional ones now. We very much feel now that we should now be, foot forward and really being a little bit more proactive. So we are looking to add new names.
Interest rates were the trigger for poor performance. Now that rates have plateaued and could maybe fall next year, could that be a catalyst for better performance?
We don't get too hung up on macroeconomics because it's very difficult to forecast. I mean, clearly, it was obvious that rates were going to go up. We didn't know how much. It's now pretty obvious that they are going to be at least at a sort of more normal level than they were historically in the last 10 years or so. That has some impacts on businesses, but we're not trying to be too cute about macroeconomic forecasts.
In terms of sector forecasts then, heading into 2024, are there any areas of the market which you think are showing a lot of promise?
Yes. I mean, again, we don't really operate on a sector basis. We end up with some sector concentrations, but that very much comes out of the companies we're looking at. So our focus is very company specific. We're really very much focused on each individual business.
Can you give me a reason to be cheerful and a reason to be fearful as we head into the new year?
It's perverse actually, because although there are many problems in the world, I think the UK has been, particularly this part of the UK, small and mid cap, has been so beaten up that it's pretty immune is too strong, but it's taken a lot of its pain early. So if there are problems elsewhere, which wouldn't surprise me at all, for instance, US tech I'd be surprised if there wasn't a problem there. This part of the market has been so beaten up, I think it's pretty resilient to bad news. Whereas on the other side, I think there's a lot of scope for upside now. The mood, I think, can only improve. The pension funds are out of the UK. The insurance funds are basically out. They've gone, so they can't do any more selling if they're not there anymore. They've basically gone. The valuations are very, very low, which I think is a catalyst in and of itself. But on top of that, you've now got scope for government action. There's a cross-party view that the UK stock market has been neglected and needs a bit of help. And we've already had the Mansion House speech, which I think can benefit AIM. There are other things that are being kicked around, which could have a significant impact. But I would if you just look at historical performance, after a negative year historically, the Numis Small Companies Index has gained 84% over the following 3 years. Similarly, when the small company sort of group in the UK trades on under 10 times price earnings, you have historically had a 60% gain in 2 years, and the current PE multiple is under 9. So it's very, very low. So I think prices have got very, very low, and that makes me it's a much more interesting environment now.
Are you seeing that optimism from companies buying back their own shares or direct-to-dealing trends at all?
Direct-to-dealing is mixed. we've definitely seen quite a lot of buying, but there's also selling, and then you have to drill into why, because a lot of it's options that mature and they have to sell for tax reasons or what have you. But I think on the buyback side, it's unequivocally changed for the positive. There are companies we own that have never done buybacks before, never even thought about it. But the valuation, and they're doing it for all the right reasons. They're doing it because their shares are cheap. You know, I hate it when buybacks are sort of lumped in with dividends and companies say that we're returning capital to shareholders. These companies I'm talking about are doing it because their shares are cheap and it's the best way to allocate capital. So to me, that's very, very positive.
Can you give an example?
Next 15 Group is a company we've owned for about 15 years. It's acquisitive in a sort of they do bolt-on acquisitions. They're not aggressively acquisitive. They've announced a buyback program quite recently. Future Group have announced a buyback program as well. Serco, I mentioned earlier, they haven't done it before. They're now doing it because their shares are very cheap. So we're seeing, but it's the right kind of buyback. That's what I like. It's thought through. It's targeted.
Finally, the question we ask all of our guests: do you personally invest in your fund?
Very much so. Now, I have a 10-digit amount of money invested in the fund, and I've always invested in it. I add each year to the investment, and I very much eat my own cooking.
Mark, thank you very much for coming in.
Thank you.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.